Institute. I'm delighted to welcome you today to today's webinar on the monetary policy and transition, the impacts and risks of the Bank of Canada's policy normalisation. Although this event is virtual and many of you are joining us from across Canada and beyond, I'd like to acknowledge that the Global Risk Institute is headquartered here in Toronto, which is situated on the traditional territory of many nations, including the Mississaugas of the Credit, the Anishinaabe, the Chippewa, the Haudenosaunee, and the Wendat people, and is now home of many diverse First Nations, Inuit, and Métis people. I acknowledge that Toronto is covered by Treaty 13 with the Mississaugas of the Credit. Now, before we begin today's session, I'd like to review a few housekeeping details. Please note your microphones have been muted to avoid any background noise. We've also allocated ample time for questions, which we will take through the chat function at the bottom right-hand corner of your screen. We'll address as many questions as we can during the Q&A portion of the event. This session is being recorded and will be shared in the past events page on our website. And finally, when leaving the event today, a survey will appear. Your feedback is valuable to us, and we appreciate your considerations for considerations for our future programming. And now I'd like to introduce our moderator for today's session, Jason Stewart, Executive in Residence at the Global Risk Institute. Jason, over to you.
Thanks, Bruce. Today's session is the first in GRI's 2022 macroeconomic webinar series. This series aims to help our members understand the transitions in monetary and fiscal policy in 2022 and beyond, with a focus upon their impacts and risks. We're going to begin today's webinar with remarks from Chris Reagan, followed by Warren Lovely. We will then move to the Q&A component with Chris and Warren, which I will moderate. I'm pleased now to introduce our distinguished guests, Chris Reagan and Warren Lovely. Chris Reagan is the founding director of McGill University's Max Bell School of Public Policy and is an associate professor in McGill's Department of Economics. Chris was the chair of Canada's Eco-Fiscal Commission during 2014 to 19, and he's a former member of the Federal Finance Minister's Advisory Council on Economic Growth. He is a former David Dodge Chair in Monetary Policy at the C.D. Howe Institute and was a member of the Institute's Monetary Policy Council for many years. Chris's credentials include his work as a Clifford Clark visiting economist at Finance Canada and as a former special advisor to the Governor of the Bank of Canada. His published research focuses mostly on the conduct of macroeconomic policy. Warren Lovely is a managing director with the National Bank of Canada Financial Markets, serving as chief rates and public sector strategist within NBF's highly regarded economics and strategy group. Warren joined NBF in 2015 from CIBC, where he'd worked for 15 years in a variety of roles in economics, strategy, and debt underwriting. Warren previously worked for the Government of Canada, including at the Department of Finance. He's published a wide range of articles on monetary policy generally and the implications of the Fed's and the BOC's policy transition specifically for fixed income markets. I will now turn the webinar over first to Chris and then to Warren for their formal presentations and remarks. Chris?
Thank you very much, Jason. Thank you for inviting me back again. And I'm very pleased to be here and pleased to be back on the stage with Warren. It was about a year ago, I think, that we were here before, and I'm very happy to be back again. So if Jennifer behind the scenes is controlling the slides, if she can go to the next slide, that'd be great. Hello?
Just working on it. Apparently it's frozen momentarily and they're just putting them back in.
Well, what I should really have is a joke ready for these moments of technical glitches, but you know, monetary policy is just not something to joke about. So we'll just wait until the slides are right and then we'll be ready to take off. Actually, let me just say while we're waiting for the slides that I think I've got 12 minutes. My 12 minutes are going to be divided roughly into half. For the first half, I'm going to talk about the Bank of Canada's new mandate, new 5-year mandate, which was a little bit different, at least in some senses, than the previous one. So I'll talk about that for a bit. And then I will talk about the forces of current inflation and where is it going? Not that I have a crystal ball, and what the Bank of Canada perhaps can and should do, and some things to think about as we move ahead. But I'll just wait for the slides here. But Jason, I will take direction from you if you want
Yeah, I
me to
was just
go
about
ahead
to
with
say,
no slides.
we got a technical glitch temporarily with the presentation, so we're going to switch to your verbal commentary with apologies, and I'll let
That's
you
fine.
paint the visual picture in addition to the text to accompany it.
That's fine. So let me just say this. The Bank of Canada, probably everybody that's watching this webinar knows that the Bank of Canada has an agreement joint with the Government of Canada, and that agreement gets renewed every 5 years. And that agreement was just renewed a couple of months ago for the next 5 years. And there was a fair amount of discussion, more discussion, I think, than we have seen in the past about what the alternatives were to the status quo of the bank inflation targeting, focusing on CPI total inflation at 2% as the midpoint of a 1 to 3% band. And what you find, and you'll see this if the slides ever get up and running, you'll see this in my slides, but the language that has the sort of what I would view as the key or the core language in the mandate renewal is there this time, and it's almost identical to the kind of parallel paragraphs and bullet points that were there in each of the 4 or 5 previous mandate renewals and the agreements. But what there is in addition is a whole bunch of extra verbiage. And one of the things that I show that you can't see yet is how much longer the mandate agreements have become. And about 25 years ago, 5 agreements ago, the agreement was about 350 words, as I recall, and now the agreement has increased in length to be about 2.5 times that. And so then you wonder, well, we need this extra length. And one of the things that we see in this new agreement is that there's always an introductory preamble about what's going on in the economy and the challenges that the Canadian economy and the Bank of Canada faces. But in this agreement, there's also a lot of extra discussion. There's extra discussion about income inequality. There's extra discussion about the bank trying to achieve not just price stability, but maximum sustainable employment. But then there's very quickly a discussion about why maximum sustainable employment is very difficult to observe and hard to define. And in any case, it's driven by things aside from monetary policy. And so one of the things that I argue, and I give the link in these slides to an essay that I wrote shortly after the agreement came out. Okay, so if we can go a couple of slides ahead. That's just showing you what I'm coining a word called wordflation, which is the increase in the length of this document. And you see how much wordflation we have seen from agreement on agreement. That's what A on A is. Agreement on agreement, percentage change in the word count. And you see from 2016 to the agreement that was just signed, a 74% increase in the length of the document. And then the question is, what is that all about? Next slide, please. And what you see here is, here's the discussion about maximum sustainable employment. So a statement that they should continue to support that, but then immediately followed by, but it's not directly measurable and it's determined by non-monetary things. And then just in case you were unclear about what the primary objective of monetary policy was, it's to maintain low, stable inflation over time. So one of the things I say is that it's almost as if this agreement is written by 2 parties that disagree with one another. And so one can imagine that one of those parties was the Bank of Canada and one of those parties was the Department of Finance, and there was just some disagreement. And rather than resolving that disagreement and then writing a clean document, instead it sort of appears like the document itself has this disagreement within it. Now, maximum sustainable employment is a term that's very close to what gets used in the US Federal Reserve when they talk about their dual mandate. But both Chrystia Freeland, the finance minister, and Tiff Macklem, the governor of the bank, were very clear to say at the press conference when this was released back in November or December, they were very clear to say this is not a dual mandate, even though when you read it, you kind of think, well, it sort of sounds a bit like a dual mandate, even though they're then distancing from it in the next paragraph. So there's a link to an essay, and I'm hoping that Jennifer can put the link to that essay in the chat box if you want to read it. Let me just say this as a final word on the mandate renewal, is that I think if you want to view this as just, let me just say, if you think that words matter and that those words are there, those extra words are there for a reason, then I think you will be led to believe that maybe the bank's behavior is going to be different in the future. But I think you might also choose to believe that this was just a case of sloppy and poor writing. And this was kind of a classic case of writing by committee that didn't work very well. Then you, I think, can conclude that, okay, the bank is still committed to low and stable inflation, and that's its primary objective, and maybe there will be no change in the future. So I don't know what the right answer is there. I'm just going to hope that it was a case of sloppy writing. Next slide, please. So let me now move into, and next slide, please, if we can. Okay, so there is inflation over the past few years. This is CPI year on year observed monthly. And here you see that inflation was pretty stable around the 2% number for the couple of years coming up to the pandemic. And then, of course, it dips rather precipitously for about a year. And then here we are now at inflation. The last reading was 5.1% year on year. So this is not core. This is headline total all items CPI. And then, of course, nobody knows where it's going to go, but this is a key question. And of course, the bank doesn't know where it's going to go, but it has to make its decisions today based on the, what it anticipates, how it anticipates the world economy and the Canadian economy are going to evolve over a while. Next slide, please. So here's the way I think about what is going on in terms of inflation. We have all heard about supply chain disruptions. Now, supply chains always get disrupted a little bit, but I think what we've witnessed in the past 18 months is a huge amount of very widespread supply chain disruptions, and that those are probably bigger and more important, and that those supply chains are perhaps more integrated than we ever really realized. That's been going on for something like the past 15 months, but I think what the Bank of Canada can do in terms of correcting those supply chain disruptions is basically nothing. Now, the Bank of Canada can change interest rates, of course, or it can change the size of its balance sheet, and I'll get to that in a bit. But it clearly can't do anything directly to impact on the supply chain disruptions. The second thing that's going on, I think, right now at the same time is pent-up demand. So lots of people like me who were lucky enough to keep our jobs and to keep our income, but couldn't really spend that much money over the past 2 years. There's lots of pent-up demand coming from millions of people, I think, like me. And I think really that pent-up demand has been really starting to present itself over the past something like 9 months. But these two things, items 1 and 2, are happening together. And so when you've got a supply chains, aggregate supply held back because of those supply chain disruptions, and demand added to by the pent-up demand, then you've just got this gap between supply and demand, and that's driving up inflation. What can the bank do about the pent-up demand? I think the answer here is not much. Just think about how unlikely it is that your desire to go on a vacation, or your desire to go shopping, or your desire to go out for dinner with your pent-up demand and your accumulated cash, just think about how interest unsensitive that is likely to be. So it just seems to me that if the bank were to raise interest rates now, they wouldn't do much to choke back that pent-up demand. They could certainly take some fuel out of the housing fire that we have all been witnessing, but I don't think you'd do much about the pure good old pent-up aggregate demand. Now, I think what we're also starting to see is that the expectations of future inflation are starting to become unleashed, if you like. And I think here's where the bank actually could take action. So today, action, in the very near future to raise interest rates, and they've already announced the end of their QE, and at some point they will start shrinking their balance sheet, I think that can actually work very, very importantly to keep expectations anchored, which I think is very important. And the final thing is that, as you all know, the bank increased the monetary base rather significantly, and I'll show you a diagram in the next picture. I'm not sure that that is adding to inflation yet, but I think very soon it may start to add to inflation, and I think the bank's got to be careful about that. Next slide, please, and then we'll talk about the bank's balance sheet. Next slide, please. There we go. So there are the bank's assets. So what you see there is the big increase in government bonds. You then see in 2020 there was the big increase in repos and T-bills, but the repos and T-bills have now dropped way down, almost disappeared. But now what's really standing out on the asset side is the huge increase in the bank's holding of government bonds. So what you see here is basically a quadrupling of the bank's balance sheet, maybe a little bit more than that. Next slide, please, to show the liabilities. So where are all of these assets in terms of the bank's liability side of the balance sheet? So here you now see the flat line is currency. So almost kind of very little unconventional growth, if you like, on the currency side. Government deposits went up hugely and then have now come back down a lot. But the big action, I would argue, is in the deposits of the financial intermediaries, right? So these are commercial bank deposits at the Bank of Canada. And to me, the question really is, where is this stuff going to go? And I think as you think about, by the way, the big reduction that you see in about the late spring of 2021, if you went back one slide, you'd see that was also a big reduction in the repos, okay? But the real question, in my view, is now what's going to happen in the near future? The economy has more or less recovered. We are back to output and employment being above where it was pre-pandemic. We're back to kind of a 2% real GDP growth path. We still have a little bit of an output gap to close, but not very much. And so the question now is, as the economy really starts to recover and demand for loans and credit really starts to recover, the commercial banks are going to start feeding that credit. And then you're going to see these deposits from the commercial banks turn into kind of credit growth to businesses and households. And I think that is when you're going to see the inflationary pressure. So the Bank of Canada is in a tough spot here. I don't think anybody needs to feel sympathy for them. They're well trained and they're well paid, and this is their job and they're good at it. But they have a problem, or the challenge, which is if they start raising interest rates and shrinking this balance sheet too quickly, then they may snuff off that recovery. But if they are too slow in raising interest rates and in shrinking that balance sheet, and I think those two things will probably happen roughly together, but if they're too slow in doing that, then I think there really is a danger for the inflation that we've seen to remain and possibly even to increase. So let me just thank you there. I'll stop and I'll turn it over to Warren. And then I hope I've sparked a few questions and we can come back to. Thanks, Jason.
Great. Well, thanks, Chris. That was notwithstanding a couple of technical difficulties, I think a great initial set of comments. I want to just reiterate it's my real pleasure to be here participating in today's session. Like Chris, I quite enjoyed the earlier discussion and I'm honored to be back. Clearly the timing really couldn't be any better. We'll have a fresh monetary policy tightening cycle kicking off in precisely 1 week's time, followed a couple weeks later by what is likely to be the first in a series of rate hikes by the U.S. Federal Reserve. So, the timing of the session, really couldn't be better. I wanted to take my few minutes to piggyback on some of what Chris has just touched on. Really what I'll seek to do is provide a little bit of perspective in terms of some of the earlier monetary policy tightening cycles and touch on what some of this shift in the monetary policy stance might mean for financial markets. If I could start with my first slide, please. So look, I I don't really want to provide much of a history lesson here. We don't have time. I think the point I'd want to emphasize is that we do have some experience with monetary policy tightening in this country. We've been using an overnight target rate as the main policy tool since the mid-1990s, or a bit more than a quarter century. And in that time, we've gone through 6 rate tightening cycles in Canada, which we've highlighted here with those red boxes and the shading. As you no doubt appreciate, and I think as we demonstrate a bit more clearly on the next slide, please, no 2 Bank of Canada tightening cycles have been the same. Certainly not when it comes to the starting point for interest rates or the magnitude and speed of tightening that was ultimately observed. Last time, which we, if we could get to the next slide. There we go. Last time, which we've labeled here as BOCT6 for, the 6th tightening. The bank clearly trailed the U.S. Federal Reserve Board, tightened policy 5 times at 25 basis points a crack from mid-2017 to the fall of 2018, topped the policy rate out at 1.75%, a level that we might have considered a bit below neutral at the time. Now, to be clear, 6 isn't a terribly large sample to study. It's, I guess, technically a little bit larger than the 4 tightening cycles we have to explore south of the border. And again, I really want to emphasize that each of those earlier cycles proved somewhat unique. It might compromise, the quality of empirical analysis that we like to do. Perhaps most unique of all, in our view, though, will be the tightening cycle that's set to commence next week. After all, as Chris just argued, the policy mandate has evolved. It's become somewhat more nuanced, even if it's not technically a dual mandate, as Chris argued. If we could go to my next slide, please. I just want to start by considering the economic backdrop. This will be arguably the first Bank of Canada tightening cycle to get going after slack has been absorbed. I'll dispense with the discussion of the output gap in favor of a look at employment. Not that the jobs data are perfect in any way, shape, or form. The way we see things, however, Canada got back to full employment really before the end of last year. And a couple 100,000 jobs that were lost in January doesn't really change that narrative too much. This rapid jobs recovery that we have observed and the attainment of full employment should be wholly incompatible with near zero interest rates. That's part of the reason why we advocated for a Bank of Canada rate hike back in January. We got that call wrong, full admission. But looking at the inflation data more recently, it might well have been a missed opportunity. If we go to my next slide, please. Chris showed you a picture of all items inflation. Here's a little bit of additional perspective. As Chris told you, inflation is now north of 5% in this country. I guess we can take some comfort in the fact that it's not 7.5% as it is in the US. And true, core inflation isn't quite as steamy, averaging a bit above 3% currently. Still, there's absolutely no comparison with where today's inflation rate is compared with where inflation was running prior to the start of those earlier Bank of Canada tightening cycles. In the past, when you might have argued that monetary policy was more forward-looking, the bank was tending to initiate tightening cycles when inflation was below target, but on the way up. The historical record, if you study it, tells us that headline inflation peaked about 12 months after the very first monetary policy tightening move. This time policy is, with all due respect, reactive. Let's just say that there's a strong hope at the Bank of Canada that in 12 months' time, inflation will not be higher. Not necessarily back on target, but hopefully considerably tamer than what we have today. That's essentially what the bank continues to project in its monetary policy reports. You see the bank's expectations on inflation at the right there. The next iteration of these forecasts comes in April. As Chris argued, it's not really clear what rate hikes will do in terms of repairing broken supply chains, arguably nothing at all. Chris also told you about the pent up demand, which might prove impervious to rate hikes. There is, however, a non-trivial share of the Canadian economy that we would deem and consider interest sensitive. Perhaps the economy is as interest sensitive as ever, in fact. And most will appreciate that we have leaned heavily on housing to drive growth in this country, not just recently, but really for the past number of years. And this is one area, housing, where rate hikes are presumably likely to prove effective in slowing a portion of demand, just as they did last go round. And if we go to my next slide, please. Just picking up a point that Chris made, I think there's really another, perhaps more important way that this looming tightening cycle will be entirely different from what we've seen in the past. For the first time ever, as we know, the bank will be supplementing rate hikes with balance sheet reductions. So it's really designed to reverse some of the large-scale bond purchases that were implemented in response to the pandemic. Those purchases saw the Bank of Canada's balance sheet surge from about 5% of GDP to 25% of GDP at its peak. It's technically closer to 20% today. That's, I guess, technically a much smaller relative share than what we see at the Fed. But the Bank of Canada's footprint in the domestic bond market is nonetheless quite significant. As you can see at the right-hand side here, the central bank's ownership share of outstanding Government of Canada bonds has surged from less than 15% pre-COVID to something north of 40% today. By design, all that buying crowded investors out of the Government of Canada bond market, steered demand as a result to other sectors and other issuers. That was really the idea. This transmission mechanism presumably works in reverse, however. And if we go to my next slide, please. We've not yet really heard what the bank has in mind when it comes to balance sheet management and quantitative tightening. We're told to expect more details next week on the 2nd of March when the bank presumably initiates its monetary policy tightening cycle. On the face of it, though, you can look at the bank's holdings of Government of Canada bonds, and you would argue that those holdings may lend themselves well to so-called passive runoff, since such a large number of those bonds are due to mature in the later stages of this year and all through 2023. You see the maturity profile at left there. So the Bank of Canada may not need to actively sell bonds back into the market to materially lighten its footprint. In fact, we may well see the bank continuing to reinvest at least a portion of maturing bonds, at least initially, as it kind of gets its feet wet when it comes to quantitative tightening. Nonetheless, to illustrate the impact, the potential impact on the market, we've shown some working assumptions at the right there, focusing on net bond supply. And I want to be really clear that the federal government's fiscal path and net financial requirement is something of a moving target. We know that the minority Liberals have no shortage of promises to fulfill, starting as early as the upcoming 2022 federal budget. But if we assume the bank lets something like 25 billion of bonds start to roll off its balance sheet in the latter stages of this year, lets something like 50 billion roll off in 2023, the resulting net supply of Government of Canada bonds to end investors will be stepping up considerably. In fact, if you look back at history, you'll see that the net supply we're likely to see will be multiples of the prior high water mark. And that will, of course, require much more active engagement, both from domestic investors and presumably international investors alike. It's doable, likely, but would presumably require higher longer-term interest rates to clear the market. In this way, we do see quantitative tightening and a balance sheet unwind as substituting for rate hikes eventually, and perhaps delaying the onset of a yield curve inversion. If we go to my next slide, please. I think we need to acknowledge that given where we're starting from on inflation, we will need, at least initially, both rate hikes and quantitative tightening presumably to wrestle inflation under some control and keep expectations anchored. At some point, however, a double-barreled approach to monetary policy tightening could prove too much, too restrictive, too damaging, perhaps to financial conditions, confidence, and risk sentiment. Effectively, that's the lesson we learned from the Fed in 2017 to 19 when they were undertaking a quantitative tightening experiment. We crossed that threshold about 12 months into a QT exercise last go round. If you look back, that was when the Fed's policy rate was nearing 2% and thus really much closer to neutral in real terms. Again, this is just one instance, the smallest possible sample, but is nonetheless perhaps a relevant one to reflect on as rate hikes in QT are about to gear up. If we go to my next slide, I just want to be clear that we're not expecting financial conditions to wilt overnight. Chris nicely showed you the evolution of the bank's balance sheet, both assets and liabilities. He showed you those financial institution deposits kind of reflected here as well. We still have plenty of excess liquidity in the system. Again, to Chris's point, that could be inflationary to the extent it really gets plugged into the economy. It's clear that this excess liquidity is still supporting asset prices, and it'll take, of course, a considerable amount of time to really drain this away. Real interest rates, at least for the time being, aren't particularly punitive, either in Canada or the US, and yield curves, to the extent we monitor these, have flattened, sure, but aren't necessarily flashing super severe warning signs just yet. I guess we'll need to see where things stand once we get a few rate hikes under our belt, which brings me to my final slide and pretty much the end of my time. As it stands, I think most will appreciate that fixed income traders, if not all economists, have braced for a pretty aggressive policy rate response, both from the Fed and the Bank of Canada. We have at least 6 quarter-point rate hikes discounted for both central banks before the end of the year. We've got 7 meetings to go, and there's some discussion of the need for a more aggressive 50 basis point hike on either side of the border, given just how red hot inflation has been. We're not entirely sure we get as aggressive a response from either central bank relative to what's been discounted. And again, I want to emphasize that we see quantitative tightening eventually substituting to an extent for more policy rate hikes. I think that becomes a real theme next year in 2023. We will, of course, need to see some material and hopefully near-term relief on inflation to quiet the nerves. However, some geopolitical stability at the margin would presumably be helpful as well. I'm not sure I'm necessarily holding my breath on either front in the immediate near term, and I guess what we would say is brace yourself. 2022 is to be the year of the rate hike, and for Canada, we'll bring a first ever dose of quantitative tightening. So I'll leave it at that, Jason and Chris, and welcome to participate, and I'm sure what will be an engaging Q&A.
Warren and Chris, thank you very much. We'll now turn to the Q&A component of the webinar. And just a reminder, if anyone in the audience has a question, and we've already seen a few, we invite you to type it into the chat box on the bottom right of the screen to all panelists. So a couple of questions to kick off. First, picking up on the inflation topic, specifically whether each of you agrees with the Bank of Canada's outlook of inflation moderating to 3% by the end of 2022 and falling back to 2% in 2023. In your view, what are the impacts and opportunities that the BOC is right and the risks if the BOC is wrong on inflation's path? Chris, do you want to start?
Sure. My sense is that if you look at the Bank of Canada's forecasts from the MPR, and if you look back at them over the last 20 years, the Bank of Canada's forecasts always, or almost always, show inflation coming back to target within, 2 years, 2.5 years. Sometimes it's a little bit later, sometimes it's a little bit sooner. But I think what that reflects is a belief by the bank that that their policy actions work, to influence inflation, and that they will get the timing, about right. But to me, in this situation, we're in a very different sort of situation in terms of the causes of inflation. So if the bank is right in terms of their forecasts, it's presumably because they are assuming that the supply chain disruptions will resolve themselves in short order, and so that inflation will then come back down. But that's one way the future could unfold, but it doesn't have to unfold that way. The supply chain disruptions could get worse. They could just take longer to resolve. They could actually create more inflation. At that point, expectations could get dislodged. So I think, I think the bank has to plot something, and they have to show us something. But I guess I don't, I'm not an expert on what's going on in all of those supply chains, and I think those are a really important force right now. So I hope the bank is right, but I think it's okay to be less confident of the bank's projections that you saw in Warren's slides. I think it's okay today to be less confident in those projections. And I hope, frankly, that the bank is less confident in those projections today than it ordinarily would be.
Yeah, if I could just pick up on that, tend to agree with that. We've been getting it wrong on inflation, not just in Canada, but in the US and really all across the globe. So your degree of conviction around an inflation forecast, whether it's the Bank of Canada's or your own, should presumably be a lot lower today than what it's been in the past. I think, Chris makes another good point. We're really, in terms of where we're operating from, where we're coming from, there's not a lot of embedded slack in the economy. So we're at presumably a more mature phase of the expansion, and so easy gains on inflation, and by that I mean an easing of inflation, might be harder to secure on its own. Now, the bank still has, of course, you see this reflected in the NPR, you see this reflected in recent commentary, a degree of confidence that we'll get some meaningful and near-term relief on inflation. To some extent, I hope that materializes because it could help keep inflation expectations better anchored. I'm not exactly, as I say, though, holding my breath on that. I think, in particular, when you look at more recent inflation data, you look at what's going on with seasonally adjusted prices, the embedded momentum that we have in the various components of the CPI. You look at upstream prices, where commodities are trading. It's I think a little bit worrisome where we are, and clearly, and again, those easy gains might not materialize without a more forceful policy reaction. And I guess that's the last point I'd make is the bank does have the stick to get back to its inflation target. I guess we hope to some extent we don't need to beat the economy too savagely to get us back to 2%.
Thanks, both of you. Next question. As the Bank of Canada proceeds with its policy normalization, do you agree with its timing and tactics in unwinding QE and near zero policy rates as it has communicated to date? If so, why? And if not, what would you recommend instead? I'll start with Warren this time and then over to you, Chris.
Well, Jason, if I heard that correctly, there was a bit of a question in there in terms of as communicated to date.
Yes.
And let's just be frank. We haven't had a whole lot of clear communication from the Bank of Canada as it relates to quantitative tightening. Now, again, I want to be kind and fair. The bank provided some guidance as they were tapering those earlier bond purchases, slowing the quantitative easing. The bank has earlier communicated, how they were thinking about reinvestment. It's clearly high time for the bank to tell us really what the playbook is as it relates to quantitative tightening. The magnitude, the scaling, the timing. Again, we're told that this is meant to come as early as next week. In the absence of that playbook, though, the market has been left to guess to some extent. We take our cue in some cases from what we think the Fed will do. We take our cue from what some other central banks are doing that have also engaged in large-scale QE. Just overnight, New Zealand for a current example. So, I think what we really need to see is a bit more clarity. And I'm not saying that the bank needs to be hyper specific as it relates to what quantitative tightening is going to look like, because of course, we're data dependent here. They want to be able to respond to evolving conditions, but some better parameters, clearer parameters in terms of maybe where they're desiring to get the balance sheet over a longer term perspective would be quite helpful at this juncture.
Yeah, I agree with what Warren is saying, and it's I don't think we should ever expect a very precise statement about how the balance sheet will shrink and over what time frame. But one of the things that I am struck by is how little conversation there is by the bank about what I put as my point 4 on my table. They talk about supply chain disruptions. They talk a little bit maybe about pent up demand, but they don't really talk about the problems, the inflationary problems that may be happening or may at some point be happening from the expansion of their balance sheet. And so, and since they don't talk about that, then they're obviously led to not yet talk about kind of the need to shrink it, and they don't talk about it much. But I actually think there's a reason why they have a hard time talking about this, and it actually relates to Jeremy's question in the chat box. The bank is, and most central banks in the past years are used to talking about the interest rate, their control of the interest rate, the short-term interest rate, and how that matters. And so, in fact, when you hear Tiff Macklem talk about QE, he says that the primary reason for QE is to actually keep the interest rate low on government bonds. But there's another reason, there's another logic behind QE, which is injecting money into the system. And it actually, at that point, you have to, at some point, have this conversation about what do you really think the transmission mechanism of monetary policy is. If you think it's only through interest rates, well, interest rates haven't changed that much, folks. But if you think part of it, if David Laidler were on this call today, and maybe he is, but if you actually think that part of the monetary transmission mechanism is through the amount of M in the system, then you actually start to think a little bit differently about the value of QE in the first place, but also of pulling back QE. They're not talking about that, or at least they're not talking much about that, and I think they do need to talk more about it.
Thanks, both of you. Chris, nice segue into questions coming in from attendees. One of the first ones is in the context, and we'll start with you, Chris, and then Warren. How do you see the new mandate influencing the bank's policy in the current phase where inflation is well above target? And I'm thinking also to Warren's comment about the more reactive approach this time versus in the past. Chris?
Well, that's a really hard question to answer because I'm not quite sure what to conclude about the new bank's mandate based on what is written down. So, there's the hopeful part of me. The hopeful part of me is that it was just sloppy writing, but no fundamental change in policy. And if that's the world that we live in, then I would say, okay, the bank is living in a confusing time. And I think actually the importance of tightening rates now, raising rates now, partly to keep expectations anchored is really important, and to prevent that inflation from the monetary expansion eventually getting into the works. Even though I know that current rates probably aren't going to change the first two things, the pent up demand and the supply chain disruption. I think there is an argument for tightening. But if in fact the truth is that the bank is thinking differently about its policy and it's less committed to keeping inflation low and stable, then we might be in a different world. And then they might just be less worried about bringing inflation back down. Now, I hope that's not the world we're in. But the truth is, I don't know. And I'm not quite sure how we will ever know. Because if you ask the governor and you ask the finance minister at their press conference, they were very clear that this is not a dual mandate. We're absolutely committed to low and stable inflation. But if you think that words matter, then there's about 500 extra words in that mandate that you got to wonder about.
I would just quickly say that, if you're willing to take, this mandate renewal at face value and the governor's words, it's not a dual mandate, then we more than satisfied the condition to get going. I would argue as well that really, even if you wanted to view it as a dual mandate, say you wanted to give some credence to maximum sustainable employment, I say we've met that test also.
Sure.
Really, if you look at where employment is running, attachment to the labor market, participation rates, employment rates, any way you want to slice and dice the employment data, I think we've ticked that box as well. We clearly know we're far, far beyond, really quite, I think, legitimately behind the curve on inflation, not just headline, but increasingly we've got core above the target band as well. So we've ticked all the boxes. It's time to get going. In fact, I think arguably it was time to get going a little while ago.
Thanks, both of you. On that aspect, one of the questions is in terms of what factors are each of you looking at to determine if inflation is becoming more embedded, either in reported gauges or in expectations. Warren, do you want to start, and then back to Chris?
Yeah, I'll go real quick because I see there are some good questions coming into the chat here. So obviously we look at market-based measures of inflation, so inflation swaps and so on in the bond market, and we can measure how market participants are thinking about inflation risk longer term. So there's all those indicators, and to be fair, those haven't totally run away from us, thankfully. There's a lot of other soft data though that I think is informative. When you look at the Business Outlook survey, and you basically have now, I won't say 100%, but let's call it 80+% of firms telling you they're going to have some problem meeting demand, and are increasingly expecting prices, input and output prices, to be higher. I think what that's flagging is that the economy's tight, and inflation is a real problem. I guess lastly, what I would tend to look at, and what probably a lot of participants could look at, is whether they're getting paid anymore. Are their wages going up? Is there and I think here again, we've got more and more compelling evidence that firms are going to need to bid, perhaps quite aggressively, to retain, let alone attract, the marginal labor that they presumably will need to meet future demand. So once you start to see that embedded and reflected in meaningful wage gains, then you start to worry about a little bit of a wage price spiral, circular sort of path that we may end up traveling.
Jason, I won't add anything. I can't add anything to what Warren just said. It's all good.
Thanks. We've got a number of questions on the chat, and unfortunately, I know we won't get through all of them, so I'm going to try and start to bundle a few. We've had several in relation to government debt, and I would propose to combine them as following. First is, do you have views in terms of the optimal path for government debt here, especially at the federal level? And secondly, in terms of the timing and combination of pivoting fiscal and monetary policy this year and beyond.
Can I start with debt?
Please.
So look, we have seen an enormous increase in a very short amount of time in terms of federal government debt. So, pre-pandemic, it was something like 32% of GDP. It went up by something like 18%. So it's now, I think it's just north of 50. And if you believe the federal government's fiscal update from the fall, it's scheduled to gently decline back to kind of low 40s over something like 7 or 10 years, something like that. But the sum of provincial and federal debt is something like low 80s as a percent of GDP. And that is only, that's less than 10 percentage points away from where we were in the mid 90s when we believed that we had hit the debt wall. So I think on those grounds, there's reason to be worried about government debt. Not that it's in an emergency situation today, I don't think it is, but debt has a habit of sort of taking off on its own, especially if interest rates rise relative to growth rates. Now that brings you to interest rates, which is interest rates are far lower today than they were in the mid 1990s. So a lot of people will look at the debt service and say, even though debt is very high today, debt service is probably has never been lower because interest rates are so low. And that is true for today. The problem is that interest rates could rise. And when most of your advanced economies are borrowing huge amounts, because we have been for the past 2 years, at some point you expect that to start driving up either real interest rates or inflation expectations, and therefore nominal rates, or maybe both. So my view is that the government and the provincial governments should be mindful of this. They should be thinking about ways to bring that debt to GDP ratio back down. I don't think there's a magic number, but I think low is good. Because low gives you the ability to respond to future challenges. We know there is aging that will drive up healthcare. We know that there is aging that will drive up elderly supports. Those are huge items. We know that there will be a green transition, which will almost certainly involve some amount of public investment. We know there will be a future recession of some type, maybe a financial crisis, maybe a pandemic, maybe a something else. But one of the benefits of having low debt is that you then have the fiscal space to respond to the next economic crap that happens. And there will be some economic crap in our future, so let's get ready for it.
Warren?
Well, okay, that was brilliant. So I'm not sure again what I'd really add to that. I think Chris made a number of interesting points, though. We absolutely have seen this transition from the focus on, debt to GDP to the interest bite, right? And again, that was perhaps quite appropriate when interest rates were low and not really moving. Becomes again a little bit more worrisome if you thought we're on a structural and sustained upward drift in interest rates, because all that extra debt that we now carry has to be financed and serviced. I think this other point about you really got to look at federal and provincial debt together. It's just critical. I think this is more critical for Canada than a lot of advanced countries. We have devolved a lot of debt to the lower levels of government, to the provincial level in particular. And of course, we know the way the Constitution's constructed, it's provinces that bear the greatest burden on healthcare. So again, I tend, like Chris, to focus on these sort of aggregate combined debt measures. We've used up some room. Thankfully, we have had the level of government, presumably with the greatest sustainability, the federal government, paying for most of the pandemic supports. I think what the next step would presumably be would be maybe generating more permanently, shifting a little bit more permanently some of the room that the federal government may have down to the provinces to help fund healthcare longer term. We know this is the ask that all premiers can agree on, of Chrystia Freeland and Justin Trudeau. I think that to me seems like an appropriate way to move going forward. And lastly, as Chris points out, I mean, this won't be the last recession, sadly, that we will have gone through, and it would be nice to have some powder dry for the next time. The economy really hits a rough spot. And I think the same thing holds as a result for the Bank of Canada's balance sheet.
I agree.
I realize the question was about government balance sheets, but if you think about the central bank's balance sheet, that's why it's timely and appropriate and necessary for the bank to make some progress on reducing its assets and shrinking its balance sheet so that we have room to buy provincial bonds, provincial money market, and of course, loads and loads of Government of Canada bonds the next time the financial system really needs it.
Thanks, both of you. Picking up on another question on the chat, in terms of indicators that you and the Bank of Canada focus upon in terms of assessing pent-up demand, the governor has quite rightly highlighted, as well as other members of the BOC, the importance of consumption and the drawdown of the high savings rates. From your perspective, what are the measures that you see the BOC using or that you gauge? And secondly, how are savings rates being properly used to gauge pent-up demand from each of your perspective?
Warren, you better start.
Well, I'll just say quickly, I'll start with this. Chris, I'm sure we'll have a brilliant insight on this, but I would say that, look, we monitor the evolution of household savings, and in particular the excess savings that has been accumulated. Effectively what we've done is we've had the Government of Canada issue a load of debt and handle a lot of the proceeds to households and consumers. And as Chris pointed out, he, like myself, we haven't really been able to to spend it the way we maybe would have liked. So there is all that pent up demand. I think the excess savings that we have, and you can measure this, and we do, across regions and income quintiles. What you'll find is that all these excess savings aren't just sitting with high income Canadians. Really we have a good portion of those savings, and if you do the work on this, that are at lower income quintiles. It gives us some confidence that consumers can remain engaged even as financial conditions tighten. But I think unwinding this savings glut, and likewise the liquidity glut, is that delicate balance, that tightrope that we need to walk, that Chris was sort of alluding to in his remarks. Because you unwind those too quickly, in terms of like removing stimulus too quickly, and shifting the burden too quickly, you could destabilize and short circuit the recovery. But I guess thankfully we do have those excess savings in our back pocket to help hopefully keep Canadian consumers engaged.
Let me just add a little bit to this. At the aggregate level, we often tend to think about savings as being a bad thing in some sense because, oh, they're saving, therefore they're not spending, and what we really need is aggregate demand to be moving along. So we need people to spend. But there's a really good reason why people should actually save. And I was actually heartened to hear that Warren said that in the data, a lot of that savings, that increase in savings, has happened at the low and middle income groups, because those are groups that I would probably argue in general don't save enough on average. So if in fact there are a bunch of households that whose financial security will be enhanced because of their excess savings, I would say that's a good thing. Let's actually recognize that as being a good thing. And right now, I would also argue we don't need an aggregate demand boost because we've basically recovered. So maybe there's a whole bunch of households out there who have done a bunch of saving in the past 2 years and will wake up one morning and realize that it's kind of nice to have a little bit more money sitting in their bank account, and it gives them a little bit of more financial security, and maybe they'll open up that TFSA that they didn't open up, or an RRSP, or start saving for their kids' education or whatever. And let's not think of that as a bad thing. I think that's a good thing.
Next question from the chat. Are there other countries, in addition to what Warren looked at and looking at the Fed's history with unwinding QE, are there other countries with more experience in implementing QE and its impact on inflation that we can look to for lessons for Canada, including the US, but obviously also the Bank of England, ECB, others that either of you would like to comment upon?
Well, the ECB is the other obvious one that we've looked to, because the ECB has been forced. I mean, we've had low interest rates in Europe for some time to utilize the balance sheet as a key monetary policy stimulus tool. The trouble, of course, with Europe is that the demographics are quite a bit different. And let's even set aside Japan as well, because we know that Bank of Canada, Bank of Japan's balance sheet has evolved pretty substantially over the years as well. So you can notionally find these other central banks. The Bank of England is a more is another one we look at. More recently, of course, we have the experience in Australia and New Zealand in this post-pandemic world to reflect on. So we know what other central banks have gone through in the past, what they're going through currently, to help guide us in terms of perhaps maybe magnitude, speed, pacing, and so on this. Again, you need to appreciate that the potential rate of growth, the demographic situation in those other jurisdictions may not compare to what we're going through here in Canada. So it makes tidy comparisons hard to come by. And again, Europe's a classic example. Just look at the ECB's balance sheet. It goes up, it desires to come down, it can never really get down, it goes back up. There's a desire to bring it down, it never really comes back down, it goes back up. What we're hopeful for is that we actually will be able to secure some consolidation in the Bank of Canada's balance sheet. Again, I think the time to get going is now, while we've got a chance.
Let me add one more reason why tidy comparisons are not so easy. you know, the rounds of QE that took place in the U.S. Fed, the Bank of England in 2009 and 10 and 11, and then the ECB after that, those were because of a financial crisis. And the recovery to a financial crisis is a very, very different thing. This is a time when private sector is deleveraging, banks are deleveraging, and so you need conditions. And I think this is the reason why Ben Bernanke did QE for the first time in the first place in April of 2009. It was to keep interest rates low, but it was also to massively provide liquidity to a financial system that desperately needed it. And it needed it for the next few years. Well, we're not in a financial crisis today. This was not a financial crisis. This was not even your good old run-of-the-mill collapse in aggregate demand. This was a pandemic-induced economic crisis, fundamentally different cause, and I think we've seen a very, very different shape of recovery, and you saw that in Warren's graphs. So I actually think the lessons about the pace of QT, quantitative tightening, the lessons from 10 years ago have to be put through a serious filter before we figure out how to use those today, because we're in a different sort of world or a different sort of recovery. So you got to be careful. You can't just draw, as Warren said, tidy lessons.
That's a good way to be coming up to the final question, with apologies to all the other good questions we won't get to. And apologies to both our speakers, but limiting your response to 1 minute. Looking back at the use and impacts of QE and near zero policy rates during the pandemic, what are the monetary policy lessons in terms of successes, issues, or risks that you would highlight? And apologies for the 1 minute limit on your response.
Okay, I'll start and I'll say something possibly controversial in 30 seconds. It is not clear to me that we needed to do QE at all. I think it was very important for the Bank of Canada to do some of the actions it did in March and April and May of 2020, to basically address serious, significant disruptions in financial markets. But it's not obvious to me that massive purchases of government bonds over the subsequent, 15 months or 18 months was necessary, because we weren't in a financial crisis. We were in a very different sort of economic crisis. And even if QE was successful in keeping interest rates down on government bonds, I think if interest rates had increased by 100 basis points or 200 basis points, they were starting from very, very low levels anyway. So now it would have been very difficult, I admit, for the Bank of Canada not to do QE when other central banks were all embarking in QE. That would have been very bizarre, I think, for the governor to stand up and say, they're all doing it, but we're not going to. But I think there is a pretty coherent argument as to why none of the central banks needed massive QE in, later than about June of 2020. So I would suggest let's have another session and have that fight.
Super quick, I'll just say
Warren?
that monetary policy is not an inert tool. It's a massively powerful tool, particularly the way we utilized it here. And to Chris's point, obviously hindsight's 2020. I sympathize with the uncertainty that we faced in early 2020, but we've overdone it. And it's time to start taking it back. So let's get going.
With both of your responses, we've come to the end of both the Q&A and our webinar today. Once again, thank you very much, Chris, and thank you very much, Warren, for joining us. To all attendees, thanks very much for your participation today. As mentioned earlier, a prompt will appear to complete a post-webinar survey when you leave this session. Your feedback's valuable to us, so please do take a moment to fill out the survey. And I also want to remind everyone of the next webinar in GRI's macroeconomic series, and that is next Thursday, March 3rd, during 11 a.m. to noon, when Bill White will be addressing the Feds and other central bank policies in uncharted waters when policy solutions exacerbate or become the problem. In closing, many thanks to all of you again for joining us today, and I wish you a good afternoon.
Thank you all.
Thank you.